When people talk about bubbles, they usually imagine a pop, a loud moment, a sharp break, a single terrible week. That image comes from 1929. But the dot-com bubble didn't end like that. Not for most people and not for most companies. There was no single day when everyone realized it was over. Instead, it faded. Quietly, unevenly, almost politely. Confidence didn't vanish overnight. It leaked away and slowly drained. And by the time many people realized the bubble was over, the bubble had already been gone for a while. By the late 1990s, 1929 was the reference point. Every bubble was supposed to end the same way. Sudden collapse, forced selling, panic. So when tech stocks began to wobble, many people waited for the crash. The big moment. The bottom falling out. But that moment never quite arrived. And the reason matters. The dot-com era wasn't built like 1929. In 1929, the system was fragile. Stock buying was heavily leveraged. Ordinary investors borrowed to speculate. Credit was tight. Bank failures spread quickly. And most importantly, when prices fell, people were forced to sell. Margin calls triggered liquidation. Liquidation triggered panic. Panic fed on itself. The system snapped. That's why 1929 felt sudden. The structure couldn't bend. The dot-com boom didn't look like earlier bubbles. Leverage was lower. Most speculation wasn't done on margin. Losses hurt, but they didn't trigger forced selling across the system. Banks weren't collapsing. Depositors weren't running. The plumbing held. That meant the market didn't need to break loudly. It could weaken quietly. Another difference was psychology. In 1929, people believed they'd found a shortcut to wealth. In the dot-com era, people believed they were investing in the future. That matters. There was no single product and no single asset. It wasn't tulips. It wasn't railroads. It wasn't housing. It was the internet. And the internet felt different. It wasn't just a business trend. It felt like a technological shift. And this made extreme optimism feel reasonable. The internet wasn't imaginary. It worked. Email worked. Search worked. Online shopping worked. The question wasn't if the world would change, but rather who would win. That uncertainty mattered. So when prices stalled, it didn't feel like fraud had been exposed. It felt like timing was off, and that delayed panic. Early dot-com optimism wasn't madness. It was extrapolation. People looked at falling computing costs, rising internet adoption, new business possibilities. And they connected the dots. If the internet rewrites commerce, then today's profits don't matter much. Market share matters. Growth matters. Speed matters. This logic wasn't insane, it was incomplete. But beneath the optimism there was a problem. And here's where things got fragile. Many dot-com companies didn't know how they'd make money. Many companies had no path to profit. Not delayed profit, but no clear profit. Unlike 1929, this didn't immediately break confidence. It didn't stop funding. Why? Because incentives had shifted. Because capital was still flowing. Venture capital rewarded growth. Public markets rewarded stories. Executives were paid in stock. Profit could wait. As long as funding continued, business models didn't need to make sense. The system ran on belief, not cash flow. One of the strangest things about the dot-com era is how normal the peak felt. In early 2000, IPOs were still happening. Analysts were still optimistic. Companies were still hiring. There was no universal panic. Just noise. Some stocks fell while others rose. It didn't feel like an ending. It felt like a pause. Here's where the bubble actually ended. Not with a crash, but with a change in behavior. Venture capital slowed. IPO timelines stretched and eventually dried up. Analysts became cautious. Questions changed from how fast can you grow to how long can you survive. No headlines announced this shift, but it changed everything. Founders were asked harder questions. Revenue mattered more, cash burn mattered more. Money just became harder to get. This kind of slow fade wasn't possible in 1929. Back then, credit collapsed immediately, banks failed quickly, liquidity vanished. There was no cushion. Once confidence cracked, the system forced resolution. In contrast, the dot-com era had buffers. Capital could hesitate and risk could retreat gradually. That's why the bubble didn't pop, it starved. This mattered because dot-com companies depended on belief. Not just customer belief, but investor belief. They needed continuous funding, rising valuations, and future promises. Once belief hesitated, the math stopped working. Not suddenly, but gradually. Hiring slowed, marketing budgets shrank, expansion plans were postponed. The system tightened. This is where the story gets boring, and that's the point. Companies didn't fail spectacularly. They didn't all fail at once. They faded. Stock prices drifted lower, then flat, then lower again. The bubble wasn't shocking anymore. It was tedious. The story became extremely boring, and boredom is lethal to bubbles. Slow declines are hard to notice. There's no moment to point to. No single villain. No dramatic lesson. People simply adjusted. Lower expectations feel temporary, then normal, then permanent. By the time optimism disappears, it feels like common sense. That's why so many people say, it didn't feel like a crash. Because compared to 1929, it wasn't. It was a surrender. The dot-com bubble didn't end like 1929 because the system was different. Less leverage, more flexibility, more time. It didn't snap, it sagged. The dot-com bubble shows us something important. Markets don't always collapse under pressure. Sometimes they starve. And that's the lesson. Not all bubbles end in panic. Some end in exhaustion. The dot-com bubble didn't pop, it slowly gave up. Not because everyone panicked, but because belief quietly stopped paying the bills. And that's why slow declines matter. Because in markets, and in history, the most important endings often happen without anyone noticing at all.